So we've had the latest Bank of England meeting taking place today, and the result was that the base rate of interest, the one they set every 6 weeks or so, has gone up again. It is now at 1%. That is a 0.25% increase, percentage point increase. So we've seen now 4 consecutive meetings, starting in December, then in January, then in March, and now here in May, 4 increases. So where we were at 0.1% just 5 months ago, a record low we'd been at since the start of the pandemic at 0.1%, we're now up at 1%. And this is actually, and this might surprise you, this is the highest rate that they've been since 2009. Since the financial crisis saw rates drop down massively. Before that, they've been around sort of 5-6%, so really, really high. But for a lot of us, myself included, this could be the highest rate we've seen while we've been homeowners. But even in our savings life, we might not have really experienced anything going up. Again, it's still only 1%. We have been at 0.75% in the last few years. So it's not like drastically different, but there is that upward trajectory. It is carrying on. So very quickly in this video, I won't go over everything in the same detail I have as last month. You can check that one out because a lot of the messaging is the same, but I will cover the basics. I'll take you through what this will mean and what I think this might mean for us and the things that you should be doing right now. Incidentally, what is worth kind of talking about here just quickly about that meeting as well. They share the voting numbers. It's got to be basically majority vote. Wherever the majority is, that's what they go for. So out of the 9 people in this Bank of England Monetary Policy Committee, 6 of them voted for the increase we saw. Okay, that was the majority. So we saw that 0.25 percentage point increase to 1%. The other 3 wanted a larger increase, double that size. They wanted a 0.5 percentage point increase to 1.25%. So this is kind of an indication. No one wanted to keep it the same. No one wanted to reduce it. This is an indication that we could see yet more increases as the year goes on. And in fact, there is a kind of like a sentiment out there from analysts and even in the Bank of England meetings own kind of, minutes. There is kind of talk there that potentially we could be seeing 1.5% or even 2% by the end of 2022. So we might see yet more increases as the year goes on. Doesn't necessarily mean it will happen. The number of times over the years that I've written or spoken about predicted interest rate rises or decreases and they've not happened is much, much, much more than they have happened. But we're obviously it's still in this certain thing. We've seen some momentum. We've seen these increases 4 on the trot. Wouldn't be surprised if we get more in coming months. Even if it's not next month, maybe the month after or who knows what. So what should you do about this? Let's just talk about savings first of all, because we've actually seen some really substantial changes in the interest rates since the last meeting in the middle of March. Now, this is partly going to be, of course, because we saw that base rate increase there as well. So again, a decent chunk, and some banks did choose to pass on that increase in the savings rates. Some of them didn't pass on the full amount. Some of them didn't pass it on at all. And sometimes if they did pass it on, it was on top of really rubbish rates already. So it didn't make a difference. But the big news, I'm sure you know if you watch my channel regularly, was that Chase Bank came into the savings market here in the UK. Only launched it as a bank here back in September. Suddenly said, right, we're going to do savings as well now. And they offered 1.5%. And this was a huge amount more than the previous Best Buy from Virgin Money, which was 1%. And that only came into play in, I want to say, February time. So we've seen a big increase. That's more than 0.25 percentage points. That's 0.5. It's going from 1% to 1.5%. Big increase. That's obviously not passing on the rate. A lot of that is down to their marketing strategy, their acquisition. They're trying to get new people to join their banks, be new customers. So we saw a big increase, but that wasn't necessarily down to the interest rate. Okay, so I think that's an important thing to bear in mind here. And then since then, we've seen a lot of other banks trying to catch up. I mean, indeed, many banks weren't even at 1% when they introduced 1.5%. There only were a handful. Now, there are a lot more. Again, not all your high street banks. A lot of these are digital ones, online ones, offering 1%. And now, some of them offering 1.1%, 1.2%. You can get 1.3% now as well in a different account. So they are slowly trying to push up their rates. And I think that some of this will be down to the last 0.25% increase rate. Some of it will be down to them anticipating a new increase coming along now. So they're thinking, right, if they're going to go up, let's maybe get ahead of the game and get some more customers because we can afford to offer this rate. But a lot of that will be coming out of the sort of marketing budget as well, trying to sort of say, look, we need to keep up with Chase because all this money is going over there. So what do I think that means now about this one? Well, as I mentioned, we've already potentially, again, I can't guarantee this, I don't know, but I wonder if some of them might already have priced in this extra increase ahead of it actually happening. And some of them might have already had to push to catch up with Chase. That's still a long way for them to go to then get up to 1.5%. And then to go beyond that, I don't think Chase will be increasing their rate 1.5% yet. They've already kind of gone at market leading. Maybe if other banks start catching up with them, then maybe they'll increase it a little bit more. But I think for now, I don't anticipate to see too much movement in the easy access accounts. Anyway, let's talk about easy access accounts. We might see more movement in the fixes. 1 year fixes have jumped up a huge amount this year. They're now around 2.11% is the best one you can get. Obviously, that could well change in the next few days. Other banks might want to push up a little bit more after this increase. And regular savers have, again, started to improve. Did a video very recently talking about them and what the best ones were. And the next day or 2 days later, First Direct announced they were doing one at 3.5%. Again, that is a sign that we're going to see, again, some of those, I think, again, it's kind of a marketing ploy there. It's for existing customers only, but again, more movement. But I'm not sure we're going to see necessarily, don't anticipate that this 0.25 percentage points will be suddenly slapped on top of all the rates. I think there'll be smaller increases. We shall see. We shall see. When it comes to mortgages, it's the same as I said last time. This is going to be where you're going to see an instant impact if you want to track a mortgage. So that's going to be an extra 0.25 added on to your current rate if you're on a tracker. So you'll pay that straight away. If you're on a variable rate mortgage, you might see an increase. In fact, you're likely to see some kind of increase, but it might not necessarily directly correlate with that base rate increase from the Bank of England. It might be less, it might be the same. I mean, they can do what they like. It's a variable rate. They might be more, or they might keep it wherever it is. You never know, but you are likely to see more going on to your mortgage there. If you are on a variable rate, I mean, this is, I think, good practice anyway. And I've said this before, there's good opportunity for you to actually hang on. Why am I on a variable rate mortgage? And as long as you have that flexibility, sometimes I know people are stuck on these due to circumstances, but the vast majority of people, it's probably because a fix has ended and they've not got around to remortgaging. Have a look, remortgage, see what the best deals are out there. See if you can change and get yourself on a lower rate. Now, obviously, this increase has probably been factored in by the market already. They've probably already gone, right, we're going to see another increase. So they might have got rid of some deals in anticipation of this happening, but some of them might not change their rates for a few days, maybe a few weeks. It might not be instant. So now is absolutely the time to kind of have a look, right, what is there right now? Don't leave it too long because, again, the longer you leave it, and if we are going to see further increases in 6 weeks or 12 weeks, whatever it might be, the next time the Bank of England does meet to discuss this, again, those rates will keep going higher if the base rate keeps getting higher. So have a look at fixes. Obviously, you can fix for 2 years, 5 years, 10 years if you want to. You've got to factor in the pros and cons of that. The longer you fix for, the more certainty you've got. So you know exactly what you're paying if rates were to suddenly jump up even more. But at the same time, it can often be hard to exit a fix. So if you have got a really long fix and you want to move house, let alone remortgage, just move house, then you might have to pay some penalties to get rid of it. So you need to be thinking a bit about that as well. You know, if you're thinking absolutely we've gone in 2 years, then a 2 year fix is probably best. If you're thinking 5 is likely, then great. If you're going to be there in your mind forever, then maybe go for a longer fix if it works for you. Obviously, the longer your fix, the higher the rate will be. So that's something to bear in mind. Now, if you're already on a fix, it doesn't mean you shouldn't be looking around now. If your fix is due to end in the next 6 months, you can normally lock in another deal within 6 months. It might be a bit shorter on some of them, but generally you can get that and go, right, you're tied in. So it doesn't have to wait until that fix ends for you to do that. So have a look now. Have a look at what offers are available. Now, if you've got longer than 6 months, then you might still want to consider switching away now. But you will have to pay an exit penalty. And that could be relatively affordable or it could be really expensive. And you will have to pay your arrangement fees on the new mortgage. So you need to factor that in versus how much will you save by going to a cheaper deal based on where you are right now versus how much it will cost you to actually make that change. But it's certainly worth having a look because, again, if we see more rates, I will say it again, then we'll see those mortgage rates continue to increase. In terms of other borrowing, obviously, if you've already got a loan, that's not going to change. You're tied in onto that. If you're going to get a new loan for whatever reason, then there is a good chance those rates will start to move up as well. The historic lows that we saw late last year, they will obviously be disappearing because we're no longer at that historic low of 0.1%. We're now at 1%. So that will be factored into the loans you can get. Similarly, overdrafts, credit cards, they could change those rates. But my top tip here, as ever, is to try and, if you've got savings, use them rather than put money on credit cards or an overdraft. Or if you absolutely have to borrow, look for 0% options instead. Shop around. Actually, same with your savings accounts, same with mortgages, any kind of borrowing. Shop around to try and get the lowest possible deal that you can, the lowest possible rate. I will give you another update on this in 6 weeks' time and let you know. In the meantime, do make sure you hit subscribe. I do a savings update video very, very shortly, letting you know what the best rates are right now. So if you are looking for the best ones, that is the place to be. My name is Andy Webb. Thank you so much for watching. I'll see you again next time.